The rupee just crossed 95 per dollar recently. It made headlines, and then news cycles moved on, without answering the obvious question underneath all of it. Can rupee get back to 70 or 80 again? And the question most people never ask, can it go back to where it started? In 1947, $1 was close to roughly 3 rupees. Today, you need close to 95 rupees to buy the same dollar. That's not one bad year or bad government. That's 75 years of movement in one direction. And understanding why it can't reverse starts with the empire. When India was a British colony, the rupee was formally tied to the British pound sterling. The pound at that time was the world's reserve currency. Countries held it at savings. International trade was settled in it. Because the rupee was fixed to the pound, it inherited the pound status. That's why in 1947, the exchange rate looked strong on paper. The rupee carried a valuation that reflected Britain's economic dominance, not India's own fundamentals. Once India stood on its own trade positions, the currency adjusted to reflect that. The number from the 1947 was an artifact of the empire. The number today is what India's actual fundamentals justify. The problem is that the fundamentals have their own structure, and that structure keep pushing in one direction for 3 reasons that have nothing to do with any particular government. The first one is oil. India imports around 80% of the oil it uses. The rest 20% is produced domestically, comes from aging oil fields in Rajasthan, Gujarat, Mumbai High, operated by Oil India and ONGC. These fields spent over a decade declining. Output has recovered slightly in recent years, but India simply doesn't have the reserves large enough to change the import equation completely. So every day, Indian refiners and oil marketing companies go into the currency market, sell rupees, buy dollars to pay for that oil. India's annual oil import bill has ranged anywhere from $96 to $150 billion, depending on global crude prices. Every dollar of that bill requires selling rupees. When oil prices spike, the pressure increases. More dollars needed, more rupees sold. And the current Hormuz situation is doing something beyond a normal price spike. It is adding a fear premium on top of that physical shortage. Aramco, which is the world's largest oil producer and exporter, their CEO recently warned that even if the Strait of Hormuz reopens tomorrow, the oil market won't normalize until 2027. The market has already lost roughly 100 million barrels of supply for every week the strait stays closed. So 2 things are happening simultaneously. A real physical shortage, oil that simply isn't moving, and a fear premium traders are pricing in the expectation that cheap oil isn't returning quickly even after the strait reopens. Traders don't wait for the shortage to arrive. They price it in the moment they think it is coming. But even if oil prices fall tomorrow, the rupee would still face the same structural weight because oil is only one part. The second is India's trade deficit. The current account measures the difference between what a country earns from the world and what it pays to the world. It includes goods, services, income, all of it. India consistently imports more goods than it exports, even after accounting for its large services surplus. India typically runs a current account deficit of around 1 to 2% of GDP in most years. What it means is more dollars are flowing out of India than flowing in through trade alone. When outflow consistently exceeds inflow, the net pressure is downward on the rupee, not just in the bad years, but most years. A crisis is sudden and temporary. A structural deficit is slow and permanent. It's a quiet weight that compounds. Third, capital flows, and this one is most volatile. India attracts foreign investments in equity markets, government bonds, and business investments. When that money comes in, dollars convert into rupees. That creates demand for rupees and offsets some of the oil and trade deficit pressure. But this money can also leave fast. Foreign portfolio investors make decisions based on global returns. When the US Federal Reserve raises interest rates, US government bonds become more attractive. In 2025, roughly $18 billion left India's capital markets, the worst year on record for foreign investments in Indian equities, and 2026 has been worse than that, with outflows in just first 4 months already exceeding all of 2025. Each dollar that left India required someone to sell rupees and buy dollars. That selling has pushed rupee towards 95. Underlying all of this is the interest rate differential. India's bond rates have historically been much higher than US Fed's rate. That gap is what makes Indian assets attractive to foreign investors. They borrow cheaply in the US, invest in India for higher returns, and earn the difference. That trade brings dollars in and supports the rupee. But by the late 2025, that gap had narrowed to around 1.6 percentage points, the lowest in a decade, and in 2026 it stayed there. The Fed has paused cuts entirely, held in a place by inflation from Hormuz crisis. The RBI has paused too. The incentive to hold Indian assets over US assets has nearly disappeared, and money followed the incentive out. The RBI does intervene when the rupee falls too much too fast. It holds roughly $690 billion in foreign exchange reserves. When the rupee falls too fast, RBI sells some of those dollars in the open market, increasing the dollar supply, reducing the rupee supply. It slows the fall, but it can't reverse the three structural forces that are driving the decline. The IMF reclassified India's exchange rate regime from stabilized to crawl-like. That's a formal acknowledgement that the RBI is managing a gradual depreciation, not preventing it. Its actual goal is to make sure the falls are orderly and slow, not as sudden and disruptive. A currency that falls 2% over a year is manageable. The one that falls 10% in a week triggers panic, capital flight, and inflation spike. The RBI's job is to keep it in the first category. The fall doesn't hit everyone equally though. India's IT sector benefits from it directly. A company like Infosys or TCS bills a US client in dollars but pays its engineers, office rents, and electricity in rupees. When the rupee weakens, the same dollar revenue converts into more rupees. Margins expand without any additional sales. India receives roughly $135 billion a year in remittances, the highest of any country in the world, and the only one to cross $100 billion. Every dollar an NRI sends home converts into more rupees. The losers are importers. India's oil marketing companies pay more rupees for the same barrel of crude. Those costs flow through petrol and diesel prices, which feeds into transport, manufacturing inputs, and food logistics. Student paying foreign university fees, anyone booking international travel, they all pay more. The dollar has something called the exorbitant privilege. The world needs dollars to trade oil, to settle international transactions, to hold as reserves. When the US prints more dollars, the world absorbs them. India has no equivalent to that. When RBI prints rupees, those rupees don't get absorbed by global trade. They stay in India. And more rupees chasing the same goods means inflation. More rupees in the forex market means a weaker exchange rate. India cannot fund its oil imports, pay foreign debts, or attract foreign capital by printing its own currency. That constraint is the structural reason the rupee has been falling for 75 years. Corruption and mismanagement have made things worse at times, but they are not the main reason why the rupee has moved in one direction for 75 years. The structure was always going to push it this way. India is working on fixing some of this. On April 1st, 2026, India mandated the nationwide rollout of E20 petrol, fuel blended with 20% ethanol, produced domestically from sugarcane and grain. Draft rules for E85 were filed just weeks ago, with E85 pumps targeted at fuel stations by 2027. If E85 and eventually E100 scales up, India's structural dollar drain from oil may start to shrink. But there's a real cost people are quietly paying. Blended fuel reduces mileage, so you burn more fuel to go the same distance. And the blended fuel costs same as regular petrol, so you pay more. Let me know in the comments what do you think about blended fuel. And here is what confuses most people. India is one of the fastest growing large economies in the world. But if you ask an average Indian whether they feel richer than 5 years ago, the most of them don't. To learn why, watch this video next.